President Trump's presidency has been anything but predictable. From trade wars to tax cuts, his policies have sent shockwaves through the global economy. Investors have been on a roller coaster ride, experiencing both exhilarating highs and stomach-churning lows. The stock market has been particularly volatile. The S&P 500 and Dow Jones Industrial Average have seen dramatic swings, reflecting the uncertainty and anxiety in the markets. One day, stocks are soaring on hopes of a trade deal. The next, they're plummeting on fears of a recession. This volatility is not for the faint of heart. Investors need to be prepared for a bumpy ride. It's essential to understand the forces at play and to have a sound investment strategy in place. Remember, knowledge is power. The more you understand about the markets and the factors that drive them, the better equipped you'll be to navigate the Trump roller coaster. One of the most significant sources of market uncertainty during Trump's presidency has been his aggressive trade policies. His administration has imposed tariffs on goods from China, Mexico, Canada, and the European Union, sparking retaliatory tariffs from those countries. These trade wars have disrupted global supply chains, increased costs for businesses, and fueled fears of a global economic slowdown. The uncertainty surrounding trade policy has made it difficult for businesses to plan for the future, leading to decreased investment and slower economic growth. For investors, the trade wars have created both risks and opportunities. Some sectors, such as steel and aluminum, have benefited from tariffs on foreign competitors. However, many other industries, including agriculture, manufacturing, and retail, have been hurt by higher costs and reduced demand. It's crucial for investors to carefully assess the potential impact of tariffs on their portfolios. Companies with significant exposure to international trade are particularly vulnerable to trade tensions. Diversifying your investments across different sectors and geographies can help mitigate the risks associated with trade wars. In addition to his trade policies, Trump has also enacted a number of significant economic reforms, including tax cuts and deregulation. These policies have had a mixed impact on the economy and the markets. The Tax Cuts and Jobs Act of 2017, which slashed corporate tax rates, provided a short-term boost to corporate profits and the stock market. However, the long-term impact of the tax cuts on economic growth remains a subject of debate. Some economists argue that the tax cuts will lead to higher investment and economic growth in the long run, while others contend that they will primarily benefit wealthy individuals and corporations, leading to increased inequality and a larger national debt. Deregulation, another cornerstone of Trump's economic agenda, has also had a mixed impact. While some industries, such as finance and energy, have benefited from reduced regulation, others, such as healthcare and the environment, have faced increased scrutiny and enforcement. Investors need to carefully evaluate the potential impact of economic reforms on their portfolios. Companies in industries that benefit from tax cuts or deregulation may see their profits increase, while those in industries facing increased regulation or competition may experience slower growth or even decline. The Federal Reserve, the central bank of the United States, plays a critical role in maintaining economic stability. The Fed sets interest rates, which influence borrowing costs for businesses and consumers, and it manages the money supply to control inflation. During Trump's presidency, the Fed has faced the challenging task of balancing economic growth with the risk of inflation. Initially, the Fed raised interest rates gradually to prevent the economy from overheating. However, as trade tensions escalated and global economic growth slowed, the Fed reversed course and began cutting interest rates to support economic activity. The Fed's actions have a significant impact on the markets. Lower interest rates tend to boost stock prices, as they make it cheaper for companies to borrow money and invest. However, lower interest rates can also lead to inflation, which erodes the value of investments over time. Investors need to pay close attention to the Fed's actions and statements. The Fed's outlook on the economy and its plans for interest rates can provide valuable insights into the direction of the markets. Section 5. Investor sentiment, fear and uncertainty in the markets. Investor sentiment, or the overall mood of the market, can have a powerful impact on stock prices. When investors are optimistic about the economy and corporate profits, they tend to buy stocks, driving prices higher. Conversely, when investors are pessimistic, they tend to sell stocks, pushing prices lower. During Trump's presidency, investor sentiment, has been highly volatile, swinging between greed and fear. Trump's unpredictable policies, the trade wars, and the slowing global economy have all contributed to market uncertainty and anxiety. One way to gauge investor sentiment is to track market volatility indexes, such as the CBOE Volatility Index, often referred to as the Fear Index. The VIX measures the market's expectation of future volatility. When the VIX is high, it suggests that investors are fearful and expect significant market fluctuations. Section 6. Staying ahead of the curve. Strategies for success. Navigating the Trump market roller coaster requires a proactive and informed approach. Investors need to stay ahead of the curve, anticipating market moves and adjusting their portfolios accordingly. Here are some key strategies for success. Stay informed. Keep abreast of economic and political developments, particularly those related to Trump's policies and the trade wars. Pay attention to economic data releases such as GDP growth, inflation, and employment figures, as these can provide insights into the health of the economy. Diversify your portfolio. Don't put all your eggs in one basket. Diversify your investments across different asset classes such as stocks, bonds, and real estate, as well as different sectors and geographies. This will help mitigate the impact of market volatility on your overall portfolio. Consider your risk tolerance. Your investment strategy should align with your risk tolerance. If you're uncomfortable with high levels of volatility, you may want to consider a more conservative approach, focusing on lower-risk investments such as bonds or dividend-paying stocks. Conversely, if you're comfortable with more risk, you may want to allocate a larger portion of your portfolio to growth stocks or other higher-risk investments. Section 7. Diversification is key. Don't put all your eggs in one basket. Diversification is one of the most important principles of investing. It's the idea that you can reduce your overall risk by spreading your investments across different asset classes, sectors, and geographies. When it comes to navigating the Trump market roller coaster, diversification is more important than ever. Trump's unpredictable policies and the trade wars have created significant uncertainty in the markets. By diversifying your portfolio, you can reduce your exposure to any one particular asset or sector, which can help protect your investments from large losses. There are many different ways to diversify your portfolio. One common approach is to allocate your assets across different asset classes, such as stocks. Stocks represent ownership in a company. They offer the potential for high returns, but they also come with higher risk. Bonds. Bonds are debt securities that represent a loan made by an investor to a borrower, typically a corporation or government. Bonds generally offer lower returns than stocks, but they are also considered less risky. Real estate investments can include residential or commercial properties, REITs, real estate investment trusts, or other real estate-related investments. Real estate can be a good hedge against inflation, but it can also be illiquid. Section 8. The long game: patience and perspective in turbulent times. Investing is a marathon, not a sprint. It's important to remember that market fluctuations are normal and to maintain a long-term perspective. Don't panic. Sell your investments based on short-term market movements or headlines. Trump's presidency has undoubtedly created uncertainty and volatility in the markets. However, it's important to remember that the economy and the markets are cyclical. There will be ups and downs along the way, but over the long term, the stock market has historically trended upwards. Instead of trying to time the market, focus on building a diversified portfolio of quality investments that align with your financial goals and risk tolerance. Revisit your portfolio periodically to make sure it's still aligned with your goals and make adjustments as needed. Section 9. Knowledge is power. Stay informed, stay invested. In today's rapidly changing world, staying informed is more important than ever. Make it a habit to stay up to date on economic and political developments, particularly those that could impact your investments. Read financial news, follow market analysts, and consider subscribing to investment newsletters or podcasts. The more you know about the markets and the factors that drive them, the better equipped you'll be to make informed investment decisions. Remember, knowledge is power. By staying informed, you can navigate the Trump market roller coaster with confidence and achieve your financial goals.